Of course, now I think I should hand over the dice to Gururaj sir. I think we shouldn't come in between the participants and the speaker. Over to you, sir.
Thanks, Pramod, for those nice words. And I should also thank Kavita for introducing me. I was just thinking Geeta to Kavita. And also, of course, Srinivas for inviting me. Immediately when he called me last Saturday or so, then I said, very difficult day next Saturday because my daughter left for Boston yesterday. And I said, I'll be not in a good mood. So therefore, I would like to avoid. But then he pestered. Then I thought this is the better way to, maybe forget the sadness. Yeah, that is how I am here. Thank you so much, Srinivas. We were always, I come from Bellary, sir. I was always telling B2B is Bellary to Bangalore. And my daughter also is B2B, Bangalore to Boston. In that way, so happy to be here in the midst of whom, I should say, in the midst of the most valuable person of our profession, Mr. Manohar Gupta, whom I value a lot for all his, whenever we have a lot of discussions, we have a small group of elite chartered accountants where I am the junior most chartered accountant. In that elite group, the issues that Mr. Manohar Gupta brings out is what actually ignites all of us to make us think. So that's how I'm honored to sit next to him. And I think Bangalore branch did a very good job of honoring him. Today, it is not only, again, I was thinking of B2B in a different sense. It is B and B. It is Bangalore and Belgaum. The connections of Bs, too many Bs there. I am also told that this is a joint program between Bangalore and Belgaum. And it is not only the audience here. They were talking about some 50, 60 registrations and about, 200 plus 300 nearing online viewers. Let me tell you, it is not only this 50 plus 300. I hear during my morning walks a lot of lectures done from Bangalore branch and all over India. So it is not only the present audience. I always say parokshavaagi ಕಾಣಿಸುವಂತಹ audience, pratyakshavaagi parokshavaagi, and also present and future audience. So I'll have to talk for the future audience also. We don't know who is going to listen to this. So having said that, it's a great job that you're doing. I don't know whether you should really discontinue discontinue this virtual mode, because give the choice. The benefit of people coming here is that they can have a better interaction. Definitely a focus will be better here. The interactions, the questions that they can raise will be given priority over the virtual audience. Definitely the future audience will not have that benefit at all. Yeah. So I would say that the people who are present here in that way are privileged to ask as many questions and probably remain focused. That is the way I would put it. So I have taken upon myself a very important topic. All of you must have read the recent guidance note which has come out from the Institute on tax audit. So I will be talking mostly with the focus on I told myself when Srinivas called, what would you like to talk? I said, I would like to talk on the audit aspects of tax audit. Of course, getting into the details. So the best part about tax audit, Srinivas, if you remember, I came here on the inaugural day when you took up as the chairmanship in February. There I spoke on Schedule 3 along with MP Vijay Kumar. Then again in June, I came here. Whatever is there in the schedule has to be audited. Therefore, audit report and CARO is what we discussed. As a logical extension, once the audit of the company is done, the next thing that has to happen is the tax audit. So in that sense, I am actually in the series of Schedule 3 to CARO and audit to now talking about tax audit. Tax audit is primarily audit on taxation. If you look into the big companies, big tax audit firms, there are taxation wing and audit wing. There is a taxation department and audit department. Which department does the tax audit? Now, which department does the tax audit? Should it be the taxation department or the audit department? Very interestingly, it is the audit department which does the tax audit and not the tax department. So which means the focus should be on the audit aspects on the subject of taxation. And it is not only because tax people, the taxation department is more probably concerned with tax planning, tax advisory and things like that, and not focusing. And probably if they do the audit, they will be doing a creative job rather than the job what they are supposed to do. And therefore, the audit is always, tax audit is primarily an audit, which we forget. And of course, taxation is important. In Hyderabad, there was a chairman by name Pankaj Trivedi last year. I told him, what is Trivedi? Trivedi means one who is an expert in three Vedas. In three Vedas. And if we have to, I said all chartered accountants also have to be three Vedis. For us, the three Vedas are the income tax audit, the income tax act. The income tax act is one Veda. Then we need to have the standards on audit. We need to have the standards on audit and the code of ethics. So these three books these three literatures will form the three Vedas for a chartered accountant. And if you happen to be doing a company's audit along with this, you become a Chaturvedi. And the fourth book is actually the Companies Act. Fourth book is the Companies Act. So that way, all of us have to be like what Manohar Gupta sir mentioned, that continue with your values. If you have to continue with your values, it is not sufficient to have just picks and here and there knowledge. All these three plus one, if you are doing the Companies Act. Yeah. So that is my focus. Sir, one thing I can tell you is, as you rightly said, challenges every year. And our profession has been accepting these challenges. So in a way, I was just thinking from what you said, CAs could be called, CA is a chartered accountant, what we know. But today I felt that we are challenge acceptors. If we can call it as challenge acceptors, we are taking challenges every year. We can't. That is why we are called practicing chartered accountants. No pun intended in that sense. We will never reach perfection. There is no such thing as a perfect life. You are always practicing. But on that, of course, I have a different note. Why are you called as a practicing chartered accountant? You are called as a practicing chartered accountant not because of practice makes a man perfect. It is not that practice that we are talking about. We are talking about practice what you preach. No, it is practice what you preach. What we preach, I cannot preach here something and in my office go and do something opposite of that. So I will not be just a preacher. I will be a practitioner of, it's not like an income tax professor who teaches only income tax and come to my office for filing his income tax return. This was one of the, I was in my initial article days, I was thinking, why is my income tax professor coming to my office to file the income tax return? Because he is a preacher. We are not only preaching, we are also practicing. So it is that practice that we are talking about, and not the practice makes a man perfect. Of course, we are perfect. Of course, we have perfect. But I was telling about one message which I gave to my daughter. Maybe it will be useful to all the daughters and the younger generation. I only told her one thing, that behind every success, what we hear, so many things are told. Behind every success, I would say there is a tremendous amount of sacrifice. And having said that, success is not a destination. It is an ever-moving goal, and in that direction, we have to take up the new challenges. Having said that, let me come to the. Can you put up the screen, please? It's coming. No, but these audience cannot see. Okay, I'll have to screen share more. Huh? Okay. So I have to do something. And just as he is setting up the stage, as the chairman was talking, since when tax audit is there? 1984, sir. 1984. I was just thinking 1984, which means 16 plus 22, 38 years. Now we have seen the parable like this 38 years. Probably if we do our job continues, it will go up. If not, like what they're increasing the ceiling from 1 crore to 5 crores to 10 crores, if they increase it to 100 crores, maybe 90% of the chartered accountants will not have any tax audit afterwards. It should not be like a parabola where it had once upon a time we used to do tax audit. Now it is artificial intelligence, the datamatics, whatever you may call, is overriding. That is why they said the limit for tax audit, in the normal case, it is 1 crore. In the presumptive taxation, it is 2 crores. And in case the entities, be it a company or a public limited company, if their turnover is up to 10 crores, as long as they are within the 95% in permitted modes, 95% in permitted modes, you don't have to do a tax audit at all. And there, they don't even have to declare the 8% or 50% presumptive taxation. So even if they're declaring less profit, they feel that the system can do a better job in finding out the mistakes rather than the auditor. So that is the future. I mean, people ask, is there a future for tax audit? I say it all depends on us. If we are doing a good job, then there will be a reliance on us. Otherwise, they will say maybe the system will throw out the exceptions. So having said,
Here, I just like to add that threshold limit of 1 crore, 2 crores and 10 crores. If you see the explanation given to 44 AD, which they added subsequently, the 5% of the total receipts should not exceed 5%, cash receipts should not exceed 5% total receipts, or 5% of payments, cash payments should not exceed of total payments. The explanation again, cash receipts or cash payments means any payments or receipts transacted otherwise than by account payee cross checks and account payee demand drafts, and also the electronic mode payments. Now the issue is when you say account payee cross checks, account payee, that there is in the Indian banking system there is no practice of giving to the account holder the paid checks. So no evidence is available to the businessman, not to the auditor also. That's the reason we give a disclaimer clause under 40A3 or 269 SSRT. In the absence of necessary evidence, we are unable to state whether the payments are made or receipts are made by otherwise than account payee cross checks and all. If that is the case, when you cannot establish whether the payments or receipts are made by account payee cross checks, then how do you ensure that this 95% of the payments are made by account payee cross checks? Is one of the things. So I think it is always advisable, even if that is the case, you please carry out the tax audit and otherwise the assessee will not be put into trouble, because when they, in case the assessing officer raises this question, there will not be any answer.
Yeah.
So virtually the limit should be considered as 1 crore only.
okay, we move to the, what is the menu for the next 2 hours that I will be talking about is in one of the sessions last week I was addressing, I was asked to give, I felt that it was a very good thing for companies. Is there an interplay between tax audit and CARO? Tax audit and companies audit report order, which is come out afresh. And then we will also talk about audit quality, then the new guidance note and cases covered under presumptive taxation. So that is what I will method. Now, what is that? The stocks should be including GST. Section 145A of the Income Tax Act says not only purchases, stocks, sales should all be including the tax portion, whether or not you're subsequently claiming. When it comes to accounting standards, it says don't include anything in inventories. In the valuation of inventories, don't include any taxes which can subsequently be claimed. Typically, we are talking of the input tax credit. We are talking about the input tax credit. So that particular input tax credit should not form part of the inventory. Now, having said that, in the accounting, the inventory is valued net of taxes, net of ITC claimable, whereas in the according to section 145, it is including the inventory is including the GST component. Is there a difference between the two? Is there a difference between the two? On inventory valuation, the answer is yes. Naturally, this will be X and this will be X plus ITC. Now, will it have a different net profit? Will it have a different gross profit? Will it have a different gross profit? You are following the exclusive method in accounting standard and inclusive method in income tax. Will that have a differential gross profit? Yes or no? Definitely no. Definitely no. Why is it a definite no? Why is it a definite no? Because in this case, although the inventory valuation is high and 145, the purchases are also high to that extent. The purchase valuation is high, therefore the inventory valuation is high. So whatever increased value in the inventory that I consider for 145A is offset by the increased valuation in the purchases. Therefore, the GP of X and GP of in the income tax will have to be the same. Once the GP is the same, the NP has to be the same, other things being equal. Other things being equal. So we have to now talk about this. Now I will talk about the guidance note. In the guidance note on tax audit, 2022-23 assessment year. The beauty of now the guidance note is, the good news, sir, is every year you will come out with a different guidance note on tax audit. Just like the bank audits. Every year, hence because the last guidance note that we got was in 2014. Although there were a lot of changes in between from 2014 to 2022 in 8 years, all those things have not been captured. So we were reading the 2014 and making sense out of it. There were a lot of changes which we will see when I come to that properly. But henceforth, guidance note will be year specific. The guidance note that has been issued in the month of August, 14th August, it was signed by the president. So in August, the guidance note which came out, I only request them to issue it at the earliest. Maybe now they had to do an editing for all the 8 years. Henceforth, it will be only the incremental additions. Now, having said that, once the guidance note is, this guidance note is, I wouldn't call it as 22. It is for assessment year 22-23. Henceforth, guidance note will be year specific. It will be year specific. Now, that's like in this particular year. Now, in the 2014 guidance note which we had, I'm sure most of you who have read it, there were at least 19 pages devoted on this exclusive and inclusive method. Sir, remember we were talking about this, and there were a couple of illustrations which were given. There were a couple of illustrations given to prove that the exclusive method and inclusive method, the net profit is the same. In the recent guidance note, Gupta sir, in the recent guidance note, they have removed the illustration. Although qualitatively they have retained that both the methods will yield to the same gross profit. Both the methods will yield to the same gross profit. In the 2014 version, they said both the methods will yield to the same net profit. That they have removed. When I was only thinking why they have removed the net profit and just kept the gross profit. Let us debate on that. And let us ask a question as to why the income tax department is so adamant. In fact, every year the institute gives the pre-budget memorandum And in the pre-budget memorandum, they every time say exclusive method and inclusive method gives the same result. Why are you keeping the differential? You can, because our accounting standards is based on international accounting standards. So if internationally that is the practice, why 145A should actually be following the inclusive method, whereas the accounting standard should follow the exclusive method? There is a good reason for the income tax department to follow an inclusive method. Let me tell you why. The reason is, all of us know that GST not paid has to be disallowed for income tax purpose under 43B. If that has to be disallowed for 43B and you are following an exclusive method, if the officer disallows that particular GST, you will say, I have never debited it to my P&L account. Why are you disallowing that? That is the reason why they are following the inclusive method and we are following the exclusive method. Probably, I don't know the rationale behind striking off the net profit. I'm thinking backwards to say that they must have, the people who have prepared this guidance note must have thought about that this net profit could be differential between the two. I mean, although it is not net profit in income tax, in accounting it is net profit, there it is taxable income. There could be a difference on account of the 43B disallowance happening in that sense. So just wanted to talk about this. The next question that is being asked in CARO is whether there are any investments, guarantees, securities, loans and advances. I use a lot of short forms, IGS, L&A. IGS and L&A means investments, securities, guarantees, loans and advances which are breaching 185. What is 185? Loans to directors. Loans to directors cannot be given. In case it is given, it becomes a punishable offense. The exceptions are carved out. I would not talk about that. Loans to any firms, any non-corporate entities also cannot be given in which the directors are interested. Loans to companies in which the directors were given prior to 2017, there was a harsh treatment, but after 2017, they have given a relaxed mode subject to certain relaxations. Loans to companies can be given subject to certain conditions. 186 is loans to anybody breaching a particular limit has to be subject to special resolution. There are certain conditions in 185, 186. What could be the implication on that on the tax audit? On the tax audit, if I said that loans to directors can be given subject to certain exceptions. For example, if it is pursuant to a scheme, if it is pursuant to a policy of the company where all the employees of the company are given loans and this director is also given a loan. And so 185 is accepting that. But even if it is accepting, or you as a company auditor say that there is a breach of 185, immediately as a tax auditor, you have an implication to say there could be a breach of 222E, which is specifically required to be reported in tax audit report. What is 222E? Loans to shareholders. It's not loans to directors, loans to shareholders given by a closely held company to a shareholder who is holding more than 10%, or not only to a shareholder holding more than 10%, or to a firm or a company in which such shareholder who is holding more than 10% in the company is holding more than 20% in that particular entity, and the company is giving to such an entity, then the loan which is given by such a company, closely held company, to such an individual shareholder or to an entity will be considered as dividends, deemed dividends, to the extent of accumulated profits in the closely held company. There is a clause on which I have to report. So the relationship between 185 and 222E. Also 14A implication. What is 14A? The clause is there in the tax audit report to say, are there any expenditures which have to be disallowed under section 14A? What is 14A? You have exempted income, the expenditure which is debited to profit and loss account on earning this exempted income should be disallowed. A couple of points here is dividends until last year were not subject to tax. So therefore dividends were always subject to 14A disallowance. Now that dividends are taxable in the hands of the receiver, what is the 14A implication? What is the 14A implication? Please be forewarned that although dividends are taxable, the entire expenditure incurred to earn that particular dividend is not allowed. Section 56 says dividend is taxed. No, I'm just coming to that. What is allowed as a deduction for earning that dividend is told in section 57, and 57 says the only expenditure which is allowed is your interest incurred to earn interest on the investment, interest on the loan required to make the investment to earn such a dividend is allowed, that too to the extent of 20% of your dividend income. So let me give you an example. I have a dividend income of 10 lakh rupees. I have a dividend income of 10 lakh rupees, and I have incurred the interest on getting the loan for the investment to make in such a company 6 lakh rupees. So the moment dividend became taxable, I was happy that I would say 10 minus 6. 10 minus 6. So 4 lakhs only was taxable. Now what they said is, now 10 lakh rupees is your dividend income. 20% of 10 lakhs, which is 2 lakh rupees, will only be allowed out of 6 lakh rupees. Balance 4 lakh rupees goes down the drain. And any other expenditure incurred, let us say I have a salary, I have a setup to run that particular show, nothing of that will be allowed for expenditure. It will be disallowed. I mean, it has to be disallowed under which section? Maybe under 14A itself. So that could be the implication. While I am on this particular subject, let me tell you one more thing. The dividends, if at all you are getting, 15 September we have to pay the advance tax. You can't estimate how much dividend the next company is going to pay. So therefore they said dividend will be subject to advance tax pursuant to the receipt, the quarter in which you receive it. So that is how they have given a relaxation on dividend. One more change in the last budget on dividends. On 14A, we always used to claim, sir, that if I did not get any dividend income, look at this, we used to say, I did not earn any dividends last year. So therefore, I did not claim any income as exempt income. Therefore, all the expenditure associated with that exempt income should be allowed. There are a lot of case laws, and we have won across by saying that particular thing, if you don't have exempt income, you have not claimed. So therefore, it should be allowed. But what they did in section 37, 14A and 37 also is, they said whether or not you have any exempt income or not, if the income is capable of being called as exempt today or in future whenever you earn, that particular expenditure on earning that will not be allowed. That's a change that they brought out in 14A. Next, deposits, 73 to 76. Please be careful. What is deposits? It says any money collected by the company could become deposit unless it fits into any one of the 18 categories of exempted category of deposits. Otherwise, the penalties could be as huge as 2 crores, 2 times the breach of the amount, or 2 crore rupees. And again, the income tax implication on paying such a penalty is, this penalty will not be allowed for income tax purpose. It will not be allowed for income tax purpose. And what is its implication on income tax? Any loans, any loan that you take, any money that you bring in as loans, advances, deposits. In fact, they don't use the word advances, they use loans and deposits and specified sums. Under section 269 SS, what is the amount up to which you can take in cash? Up to which you can take in cash is, what is the amount? 19,999. That 1 rupee can make a big difference. In one of the cases, the chartered accountant, he had 1 lakh rupees in the books as loans, and the scrutiny notice came, and he told his junior to make it 269 SS compliant in the books. He made exactly like this, 20,000 into 5. And he asked this junior whether you have done properly. He said, I have done, sir. Then he took it to the officer and opened the book. He said, I'll charge you 1 lakh penalty. The difference between that 19 up to 19,999, you can take it in cash, but beyond that 20,000 and above has to be in what? In permitted modes. What is permitted mode? 3 plus 8. 3 plus 8. All the sections 40A3, 269SS, 269T, 269ST, and there are a lot of other sections where they talk about account pay check, 56.210, 50C. All these sections talk about permitted modes, and everywhere they have talked about, one is account pay check, account pay draft. That is what Manohar Gupta sir was talking. How do you know that it could be a check? How do you know it is account pay? Therefore, normally we give a rider that it is paid through check, but we don't know whether it is account pay or otherwise. That's a normal disclaimer that we give. In fact, in the tax audit question itself, they ask that particular thing. So account pay check, account pay draft, electronic clearing system of the bank, plus other permissible modes. So where is it permitted? They have talked prescribed modes. That's the word, or such other modes as may be prescribed. Where is the prescription? I mean, even in Companies Act, we have prescriptions. Whenever it is told as may be prescribed, it will be prescribed through the rules. It will be prescribed through the rules. And for this purpose, which is the rule that we have to refer to? Rule 6ABBA. Rule 6ABBA, they have given 8 permitted modes. In Rule 6ABBA, popular is Rule 6D. We talk about Rule 6DD, but for this purpose, this eight permitted modes are given in Rule 6ABBA. What are the 8 permitted modes? Credit card, debit card, NEFT, RTGS, IMPS, BEAM, Arjun and Yudhishthir. And you can put it like that. I'm just putting, there are 8 permitted modes. So you'll have to go into those 8 permitted modes. 269SS. What does 269SS say? Any loans or deposits or specified sums in excess of 20,000 or more should be taken in these permitted modes. What is the meaning of specified sum? What is the meaning of specified sum? Specified sum could be advance or otherwise in relation to an immovable property. That means I am selling an immovable property. Towards that sale, if I have taken any money, that money is this specified sum. More than 10,000, 20,000 or more should be by way of permitted modes. Am I clear? Next, 269T. What is 269T? 269T is a repayment of loans, deposits, or what? Or specified. Please look at this. In SS, the full form of SS is specified sums. If you can see the pun there. 269 SS is specified sums. Loans, deposits, or specified sums. Definition of specified sum is advance or otherwise. Advance or otherwise. What is or otherwise? Advance received in relation to immovable property or otherwise received in relation to immovable property. What is otherwise? The sale consideration itself. I mean, if I'm selling up immovable property, I may either receive the advance. I mean, maybe 2 crores is the advance, 2 crores is the transaction value. He will give me 50 lakhs in advance, and 150 lakhs at the time of registration he will pay me, which is not an advance but the full value of the. So it could be the balance of the sale consideration. Or entire 2 crores I can take it as at the time of registration. So if somebody can challenge that, no, it is not advance, it is the final sale value of which I can I take it in cash, means he says advance or otherwise, that means the sale consideration itself also has to be in the permitted modes. So this is for 269SS. Now let's talk for 269T. For 269T, repayment of loans, deposits, or he does not use the word specified sums. He uses the words or repayment of specified advances. Why? Because once it is it is towards the sale consideration registration has happened, there is no question of returning the sale proceeds itself. So therefore 269T uses specified specified advances and not specified sums. That is a distinction. So one is for receipt, one is for repayment. Please be careful. I always keep telling this. If I have given loans to Geeta madam, I have given loan of 50,000 rupees to Geeta madam in cash, who is wrong? The giver or the receiver? Why I am wrong? Under which section I am wrong? Under which section I am wrong? 269 SS, loans should not be taken. Loans should not be taken in more than 20,000 or more in permitted, other than in permitted modes. So I have given loans. Have I made a mistake? No, I have not made a mistake. I have not made a mistake. Who has made a mistake? Geeta madam has made a mistake. Now, after 2 months, she returns the money back to me. Again in cash. Again in cash. 50,000 rupees, Geeta madam has returned it to me. So whose mistake it is now? Why both? Under which section both? 269T says the person who has to return the loan has to return it in permitted modes. So therefore, I am not wrong, madam. All that I wanted to prove is you are wrong. Now please understand. Now let us change the example. In the same, I have given to Geeta madam in cash, and Geeta madam has returned it to me. Instead of 50,000 rupees, let me make it 2,50,000 rupees. 2,50,000 rupees. So I have given 2,50,000 rupees to Geeta madam. Under 269 SS, Geeta madam is wrong. Now, after 2 months, she returns this 2,50,000 rupees back to me. Under 269T, she is wrong. Under 269 ST, I am wrong. Now, because ST says anything more than 2 lakh rupees should be received in cash. I mean, should be received in permitted modes. In fact, if you go back to my earlier example, 50,000, 50,000, where I have given 50,000, what happens probably if I give it in cash, 50,000 rupees, and she returns it back to me in cash, the auditor of this entity, I will call Geeta and Company, if that is the entity, the auditor of Geeta and Company will never see this transaction in the books of accounts because it is out of books. 50,000, mostly cash means it is out of books. So it will not be seen in the books of accounts. So how will the auditor know that she has received or paid in cash? Not possible if it is not accounted at all. That is why if you see 2 years ago or 3 years ago, 4 years ago, they changed the tax audit report format to include the person who is giving also has to report whether it is given otherwise than in cash. I mean, whether it is given in permitted modes or non-permitted modes. So I will give that report. When the auditor of my firm will, I'm not an auditor, let us say, the auditor of my firm, or I am subject to auditor as a chartered accountant firm, my auditor will have to say, probably if I am showing it in the books, probably they think that the person who is doing it is in the form of a business, and therefore he doesn't have the penalty. He will openly say that, yes, I have given it in cash. So looking into my tax audit report, if there is a payment in cash, the other person's PAN is asked. So based on that, the inquiry can happen on the other person. So that is if you see the questions in the tax audit report, they are asked not only from the receiver's perspective, but also from the payer's perspective. Payer will not be punished for the breach, but looking into the breach of the payer, the receiver will be penalized. So that is the intent of that particular clause.
The thought is not necessarily, suppose cash is not brought into books of account, no question. It will not appear both either in Geeta madam's books or Mr. Acharya's books. Where the cash is recorded in the books of accounts, generally what department thinks that the wrongdoers auditor, there are chances of omitting to report. But if it is let us say in the same example, Mr. Acharya's auditor say, because he has not done any wrong thing. He has not done any wrong thing. in this. So here what happens, they can freely, they can give a report because this is nothing going to affect the client here. It is going to affect the other party of the transaction. That must be the intent of the department to see that based on this cross reference, they can catch the other party why you are not reported.
So 269SS we have covered, 269T we have covered. What is 269ST? What is 269ST? It need not be only loan repaid, loan received. It could be any amount received, whether pertaining to your P&L account or a balance sheet item. Anything more than 2 lakh rupees, PTE, per person P, per transaction T, per event or occasion of more than 2 lakh rupees should be received in permitted modes. Otherwise, it becomes a breach. And the breach for both 269 SST and ST is 100% of the amount received is the penalty under 271 D, E, and DA respectively. So that is the implication, unless there could be good and sufficient reasons as to why you accept it. Can hospitals collect money in cash? Hospital, let us say operation fee is 3 lakh rupees. Can they collect it in cash? Even for them, there was for the COVID period a limited window. Now I will show you that particular window. Barring that particular notification which said from March to some June, okay, of 22, you could have taken, of 21, you could have taken, even for hospitals, there is no way that they can take it in cash. If they take it, they have to go through the, and let us now, as auditors, can we say, they have got good and sufficient reasons, so therefore they have taken it in cash? Please understand, the good and sufficient reason is from the point of view of the assessing officer. We as tax auditors are assisting the assessing officer to take a decision. We cannot take a decision. I cannot say he has paid more 2.5 lakhs. If they say that, no, sir, it is inevitable, the person was saying I could not have operated, so we paid in cash. If I did not take this, if by the time he made a DD and came back to me, the patient dies. I should have taken it and performed this operation. If he says that, you cannot say Ayo Papa and leave him there. If you say Ayo Papa, nobody will be there to say Ayo Papa for your case when it is taken up for disciplinary matters. So please report, let the Ayo Papa, you plead for that in future for the penalty not to be levied. Undisputed statutory dues or disputed statutory dues, which is getting reported in CARO, could have a 43B implication. Could have a 43B implication. The moment you say here that the dues, statutory dues are not being paid promptly, and the following are the ones which are outstanding for more than 6 months, and on the return filing date, because the due date for filing the return, it is still outstanding. That is a beautiful part is, or either a challenging part is, on 30th of September, the due date is for your audit report. 139 due date is next month. For 43B, what is the due date? Tax audit due date or income tax return due date? Income tax return. Now the assessee will say, I will pay it in the month of, now bonus and all, they will say I'll pay it in October. October 4th, 5th, I will pay. Dasara. I will pay it in October. Can you take a management representation letter that he will pay and say that it is going, it should be allowed? Can you do that? The answer is no. But he is allowed. So what will you do? Rule 6G has been amended. In fact, without that amendment also, we could have exercised that right to say on 30th September, when you file your tax audit report, you say that the bonus provision is made. This has to be disallowed under 43B. Whether it is paid by the due date means you will say not paid, paid or not paid. You will give that figure. In case he pays it on 4th September or 4th October, you revise the tax audit report. You revise the tax audit report, because if you don't revise, what happens is there will be an automatic addition by 143(1)(a) itself. So they will add back, because your income tax return would have claimed tax audit, because for them tax audit report is superior to income tax return. They will add back. So what you do is you revise your tax audit report to that extent once he pays. So that is permitted expressly now. Earlier it was implied, and now it is expressly provided in Rule 6G. So 43B. Similarly, now 36(1)(5). Imagine there is a PF payable to the extent of the employee's contribution. Until 2020, we had a good time to talk about so many case laws, S.A. Taraka case and all those stuff. And up to 2020, even now, we are arguing that it should be permitted. Employee's contribution. Employer's contribution was always covered under 43B up to the due date of filing the income tax return. Employee's contribution is the most dangerous. You must tell them that 15th ka if you pay on 16th, it will not be a subject matter of deferred tax asset. I mean, I'm just trying to go further. When it comes to 43B items, if it is disallowed on the income tax return, you can create a deferred tax asset. Although you may have an immediate tax outflow in the year in which you pay, you can get so therefore a deferred tax asset. But when it comes to PF, ESI with respect to employees' contribution, it is 15th ka if you pay on 15th after 12 o'clock, because on 15th PF ESI website does not work. Can that be a reason? That can be a reason with the ESI PF department, not with the income tax department. I don't know. ಅವ್ರದ್ದು ಏನು ಅಣ್ಣ ತಂಗಿ ಸಂಬಂಧನೋ ಗೊತ್ತಿಲ್ಲ. I mean, I'll say ಅಣ್ಣ ತಂಗಿ ಸಂಬಂಧ. You see, the ladies generally are benevolent. ಹೋಗ್ಲಿ ಬಿಟ್ಬಿಡಪ್ಪ, ಇಂಟ್ರೆಸ್ಟ್ ಹಾಕ್ಬಿಟ್ಬಿಡು ಅಂತ ಹೇಳಿ the ladies may say. But this ಅಣ್ಣ says, ನನ್ನ ತಂಗಿಗೆ ನೀನು ದ್ರೋಹ ಮಾಡಿದ್ಯಾ, ಆದ್ರಿಂದ I will murder you. Income Tax Act is telling that if you pay on ESI PF Act is saying 15th if you pay 16th, if you can prove that your website was not working, they may say, okay, I'll not charge you penalty, but please pay interest. So I just pay interest and forget it, which could be running into hundreds. But if it's 10 lakh, 12 lakh, 15 lakh rupees of ESI PF, if I don't pay, I will end up paying 2.5 lakhs of tax, and for a delayed payment with interest, 234 BC. So that could be the implication. I
think that is the reason for this year, April, June and March, 3 months, the ESI department, they have given extension by 15 days, 1.5 months and 15 days.
Because of COVID.
Because the portal was not working. So they have given extension.
So then that should be the due date. Please ensure that you cannot blindly say 15th May, 15th June, 15th, when actually the department has extended the due date to whatever. So you should have that particular template ready and feed that as the due date, and then tackle with that. Now, two things I wanted to tell you on this. One is 3615A. How is it different from 43B? That means how is the employee's contribution different from employer's contribution? Employer's contribution, please understand, employer's contribution, 10,000 rupees is a salary which I'm paying the employee. Employer is paying from his pocket another 600 rupees. Another 600 rupees. So together, so 10,000 rupees is my employee salary. 600 rupees is ESI, my contribution, debited to P&L account. So 600 is going out of my pocket. Whereas employee's contribution, 10,000 rupees, I will deduct 500 from him. I will deduct 500 rupees from him and put it in my pocket. So it becomes income under 224(10). What I am giving to the employee is now not 10,000 but 9,500. I am giving 9,500 to the employee. 500 rupees I am putting it in my pocket. 600 rupees I am claiming it as, so employee is getting only 9.5. The ESI PF department is getting 600 from my side and 500 if I pay from my pocket, 500 rupees. So the moment I put it into my pocket, it becomes my income under 224(10) and will be allowed as an expenditure under 3615 if and only if I pay it within the due date as prescribed under the respective acts. So that is the differential. So while one is an expenditure, the other one is an income and allowed as an expenditure. Other one is an income and becomes a expenditure. So to this extent, they were always different. But somehow the courts have been benevolent, which benevolence have been curbed from 1/4/2020. Having said that, I want to ask you one very interesting question. Salary of July, and now August, let us say salary of August, 31st August month salary, I am paying on, let us say September 3rd. Today I'm paying September 3rd. What is the due date for PF? 15th, my question is 15th of August or 15th of September? Okay, I confused you. 15th of September. Is it 15th of September or 15th of October? Can we take his argument? Your good name, sir? Varshit. Yeah, Varshit is telling that I paid the salary. Now I'll give you two situations, Varshit. August 31st, most of the employee driven companies where the management is consisting of employees, August 31st salary, they pay it on August 28th only. I don't know whether you understood. Employee driven companies and employer driven companies. Employer driven companies will try to give as late as possible. Okay. Employee driven, let us take before only, doesn't matter. So if August month salary is paid within the month of August, then definitely 15 September is correct. Varshit is telling that I have paid the salary of August on 3rd September. So should my due date be 15th September or 15th October? According to Varshit, it is 15th of October. Do you agree? What does the PF Act? Does the PF Act recognize accrual system? So this is the take home point for this. Varshit is giving you a very, very good, what should I say? A very good suggestion, which is acceptable to me and to the court. Look at this. Madras Tribunal and Mumbai Tribunal have got into this on tax matter and given a justification and have given upheld the assessee's argument to say that PF is based on payment. PF is based on payment. So even if you don't pay it by one day, now you take an extension of 1 month. Yes, sir. Going by this case law, it is yes. Paid means, I think that the logic is now like this. I fully agree with the logic of the courts. This is how it has been argued. What they must have told, I don't know the actual arguments. 10,000 rupees I am giving to the employee and I am putting 500 rupees into my pocket. When am I putting it into my pocket? When I am giving it. If I have not given it, where is the question of putting it into my pocket? So therefore, when I am giving this, it should be considered as given, and from there it should be counted as 15 days from the end of the month in which it is paid. While this is true because of the wordings used in PF Act, what Varshit told, I agree fully, and the courts have agreed. Whereas in ESI, it goes by the calendar month to which it pertains. So that is a succinct difference in the Act itself. You can go back and do a research, and it has been held by Mumbai Tribunal and Chennai Madras Tribunal accordingly. So let's take that as to our advantage. Sir, your views on this?
I agree. I definitely agree with Varshit. So I think only thing we have to take care that only in case of provident fund, we can take this argument, but not in the case of ESI.
Yeah. So you put as the due date as August only. You put the due date is as 15 September and paid. In this case, it will be 15th October, and you paid it by 16 September.
You have to put the due date as 15th October.
October. You have to put the 15th October. Yeah. So whenever you paid, that subsequent month, 15th, will become the due date. if you want to take such a, I mean, definitely, yes, it will not be a misreporting from the auditor's perspective, provided you give this case law also. I will give you the case law. I'll give you the case law, sir, in some time. Okay. I just wanted to bring out this thing. Instead of coffee or tea, we thought, well, this is a better coffee or tea. You know, if this is something which all of us will be affected, not us, most of the clients, and for genuine reason, discuss, debate on this particular case law and tell that there is a way out like this. Tell them one thing we always keep telling, that ESI, PF, whether or not you pay our audit fees, please pay the PF promptly. They take that very seriously. No, sir, that's what I'm telling. The PF Act itself is so built in, it is linked to.
Sir, it is not connected with the method of accounting. Yes, method of accounting, what you are following, what is there. Even you make a provision, I understood your point. You make a provision for the salaries and wages, what is payable, it is accrued, you are making provision. But if you have to go, no, sir, that is as per the accounting point of view of the books of accounts. Now you look into the tax audit angle, what the relevant statute speaks, the Provident Fund Act or ESI Act, what say, what is the due date as per the, because they say due date specified in the relevant acts. This is only for employees' contribution, not for employers.
Yep, this is the case law. Yes. That is from which act? So that act should penalize you for that. So I would only say PF Act says, I'm just putting up the case law which I was talking about, within 15 days of the close of the month in which wages for any period are paid. Paid includes payable, nahi bola hai. And we have fluid air case here and Madras radiators case here in support of what we are talking about. So use this whenever you want to. Otherwise you go in, if everything is paid on normal, you use a different methodology. Wherever there is a delay, please forewarn the clients. I always tell them that that is not right. Please do that. But if they say, sir, what, mera to mistake nahi hai, why are you punishing me so much, means tell them this case law. And if you are too much worried, you mention this case law. According to this, I have applied. Now, where will you mention all this? If you have a litigating view, where will you mention all this? Because under that particular clause, you have to give only the due date, actual date, and the amount. You don't have a mouthpiece to tell there. You have a big mouthpiece in clause 3 of 3CA and clause 5 of 3CB. Please understand, 3CA and 3CB are given in different situations, but for both, the attachment is 3CD. Now I'm coming to the actual tax audit. So 3CA is given where, for whom? When will you use 3CA? Where the audit of such an entity has already been done under the requirement of any other statute, you use 3CA. In that context, you already have an audit report issued under that respective act. And audit report on what? Audit report on the financials. You already have an audit report on the financials. And now 3CA is giving a covering letter to that audit report. This is what Manohar Gupta sir was telling, that 3CB is an audit report. And I go to the extent of putting 3CA as a covering letter to the audit report and mentioning that 3CA, I'll say this is the name of the company, this is already audited by so and so. And 3CB, the second clause says the information required is given in 3CD. And then clause number 3 of 3CA says the observations with respect to clause 3CD are given below. That is 3CA. When it comes to 3CB, it is indeed an audit report. The audit of the entity is happening for the first time. The audit of the entity is happening for the first time. That is when you give 3CB. What could be such a situation? A sole proprietorship, a partnership firm. Can there be a situation where you have to give 3CB for a company? Can there be a situation where you can give a 3CB for a company? If the statutory audit is delayed for whatever reason, I don't know if I can take the example of Byju's. Byju's the company balance sheet is not finalized for 31/3/21. But if the tax auditors were different and they wanted to do the 3CD filing, the tax audit report, they should have used 3CB for doing that. In fact, the latest guidance note talks about another situation. So this may be interesting. They talk about another situation where, in the case of mergers and acquisitions, the court gives the effective date subsequently. Subsequently, they say that 31, it is from 1/4/21. From 1/4/21, the merger is deemed to have happened. They give the takeover date as a different date. So what happens is that 21/22, effectively that company is not there for ROC purpose. But 21/22, I have done the transaction for which I have to file my income tax return using 3CB. That is a situation which they have talked about in the revised guidance note on tax audit.
In case of LLP, when you are doing a tax audit, which form, whether 3CA you use or 3CB you use?
So the answer for that depends on whether the LLP is subject to audit. When is the LLP subject to audit? 25, 40, and third reason. There are three reasons. One is 25 lakhs contribution and 40 lakhs turnover. In fact, why 40 lakhs means, Manar Gupta sir will say, in 1984, 40 lakhs was the cutoff. Right? 40 lakhs was the cutoff. So they have LLP Act has somehow been there. So 40 lakhs. Or if there is a voluntary agreement between the partners that it should be compulsorily audited, and where the audit report on such an LLP is given separately, SA 700 report is given on the financials, then you use 3CB. Now 3CB is a very interesting format. 3CA has got three clauses. 3CB has got 5 clauses. 5 clauses. And 3CB, the mouthpiece for the tax auditor is clause number 3. Clause number 3. Whereas the mouthpiece for the 3CB auditor is 5 and 3. There are 2 mouthpieces for 3CB. There are 2 mouthpieces for 3CB. There is a clause 3 and clause 5. Clause 5 of 3CB is the same as clause 3 of 3CA. I wanted to give the benefit to the people here because they can watch me and focus. People who are watching in their respective offices, they'll be doing so many things and they'll never be able to understand what I'm saying. I wanted to give the benefit to you. Now look at this. The clause 5 of 3CB is equivalent to clause 3 of 3CA. Am I clear? So whatever you want to talk about it with respect to 3CD, fluid, whatever you want to talk fluidly or whatever you put that particular case law, you put that there if you want to take that as some case law a benefit if you want to take. What do you say in clause 3 of 3CB? Clause 3, look at this. The observation, the qualifications with respect to the financials in 3CA, which would otherwise come in the main audit report, that accounting standard 15 gratuity has not been provided, accounting standard 2 inventories have not been properly valued, which will be given in the main audit report. In 3CB, you are giving that under clause 3 of 3CB. So clause 3 of 3CB is with respect to the financial statements, qualifications with respect to financial statements, observations with respect to financial statement. Clause 5 of 3CB are observations, qualification, and comments with respect to 3CD, which is equivalent to clause 3 of 3CA. Now, income surrendered during assessment is one of the clauses in CARO. For the purpose of tax audit, there is no requirement to say, but those things have an income tax implication. I'll stop there. Default in repayment of loans is a comment in CARO, whereas the default in repayment of loan itself does not have an income tax implication. Interest on such loans will not be allowed under 43B in the same manner. But a word of caution is interest to banks, you don't have to subject them to TDS. But interest to, when I always take the example of HDFC Bank and HDFC Limited. HDFC Bank के लिए 194A says TDS is not required to be done. But HDFC Limited mein, it is applicable. So Kotak Bank and Kotak Primus. So these are very apparent, but any other person, if they don't have the suffix bank, then they are an NBFC on which TDS is required to be done. How will you do the TDS? I would have given a 36-day post-dated check. I have given a 36-day post-dated check. How can I do means income tax department does not bother about how will you do. You do, that's all. He says you do and give a 26AS or a 16A to him and have an arrangement where he will return it back to you. That is a practical thing that can happen. Private placement and preferential allotment. Whenever there is a private placement, preferential allotment, rights issue, in short, additional shares raised, 5627B of the Income Tax Act will have to be studied. What is 5627B, which has to be commented even in the tax audit report? 5627B says, whenever a closely held company allots shares at a premium, and such a premium is more than the fair market value, the difference between that more and the fair market value will be taxed in the hands of the company under 5627B. A study has to be done. If you issue more, the company will be taxed. If you issue less than the fair market value, the allottee, the assessee to whom the shares are allotted, he will be subject to tax under 56(2)(10). So that is a corollary to this. Related party transactions, talking about 177 audit committee, 188 wherever all companies have to comply with related party transactions. What is 188? 188 says if the company has any transaction with its related parties as defined under 276, 2(76), then you will have to see whether it is at arm's length and in the ordinary course of business. If the answer is yes, no action required. If the answer to any one of them is no, then you go further and say, are there within the acceptable cutoff limits, or whether it is breaching the cutoff limits. If it is within the cutoff limit, a board resolution is sufficient. If it is beyond the cutoff limit, it has to go through the members' resolution, ordinary resolution. That is the requirement under 188. What is the requirement under income tax? Income tax, whether it is at arm's length, whether it is in the ordinary course of business, whether it is within transaction permitted or beyond transaction permitted, limits permitted. Under 40A2B, if there are any transactions between the company and its related parties as defined under section 40A2B, it could be directors, partners, firms in which the directors or partners are connected, or relatives of such directors and partners and proprietors. What is the definition of relative? A popular thing for income tax, it is aju baju, aage piche, upar niche. That means aju baju, husband and wife, aage piche, brother and sister, upar niche means lineally ascendant and lineally descendant. Relatives are very, very difficult. For income tax purpose, my grandfather is a relative. For Companies Act purpose, my grandfather is not a relative. Companies Act says aju baju, aage piche, just upar, just niche. My grandfather and grandchildren are not relatives under Companies Act. Similarly for accounting standards. Similarly for accounting standard 18, relatives are aju baju, aage piche, just upar, just niche. Why grandfather is not a relative means, sir, they have borrowed it from international accounting standards. In international accounting standards, calling father and mother as a relative itself is a great job. So that is how the lineage comes. But one point to be noted under Companies Act, aju baju, aage piche, just upar, just niche, and they have added two more relatives: son's wife and daughter's husband. Who is the son's wife? Son's wife is daughter in law. Which law? Now you know. So she is my daughter and she is my daughter in company law. You'll have to put it like that. So the point I'm trying to say is, it could be a story that I'm creating, but this is how it is. This is how it is. Now tomorrow we said deposits can be taken, exempted deposits in the case of a company can be from directors, You can take money, any money is exempt. Relatives of directors for private limited companies you can take. Now, who is a relative? If you take it from a grandfather, gone. It will not be, as an auditor, as a CARO auditor, I have to say that your grandfather is not a relative. I mean, that is how the implications are. So related party transactions, 40A2B. 40A2B, fortunately, when it comes to income tax, it is talking only about expenses. It is not talking about incomes. 188 talks about incomes also. Does it go to balance sheet item? The answer could be no. It is only expenditure in related to profit and loss account. 92E, transfer pricing issue, primary, secondary adjustments, and thin capitalization. Non-cash transactions with directors or persons connected therewith, 40A2B. Specifically, please understand, ratios. The tax auditor also has to comment on ratios. In the companies, there are ratios given. Now, Schedule 3 wants 11 ratios to be given. And the CARO auditor has to comment on these ratios for a different purpose, what Manor Gupta sir was talking about. Does the company, based on the financial ratios, and so many aging analysis, information available from the management, does the company have the wherewithal to meet its liabilities in the next 1 year? Can it repay its liabilities in the next 1 year? Is the CARO question. But there are 11 ratios given in the financials itself. There are 4 ratios given in tax audit report. Right? Out of these 5 ratios, there are 5 ratios in the tax audit report. Out of these 5 ratios, 2 ratios out of 11 ratios are the same. Inventory turnover ratio and net profit ratio. There cannot be two figures arising out of the same financials. So please ensure that that is matching. CSR we already discussed, 135, 136. I would not like to take further time on that. So we'll move to the next topic, which is the guidance note on what are the changes in this particular guidance note 2022-23. First of all, I told you it is year specific. All these days, I think once in 1984, and then bits and pieces, it was given 7 times they had made a revision. This time is 8th edition. When they call it as the 8th edition, it has got 446 pages, and it is available in the hard copy also. Kota Srinivas has sent a message to all of us saying that you can better buy a hard copy also, available for 500 rupees. Now, earlier guidance note was issued in 2014. I told you after 2014, forget about the changes which have happened in the law. Notifications, circulars, FAQs, so many things have come. The tax audit report itself has undergone so many changes. Earlier, it never used to be in 2014. I think it was about, I don't remember exactly. It used to be some 28 clauses or things like that. Now it has become 44 clauses. In 2016, there was a minor amendment when the ICDS came into picture, which Mohan Lavi is going to talk about. Clause 13, I think. The clause 13 of the tax audit report, they made certain changes to bring in the deviations with respect, is the profit going up or down on account of ICDS, and the disclosure with respect to ICDS also has to be given in clause 13. So to that extent, there was a change in the tax audit report format. Pramod, have you come to say something? The coffee or tea is at 12. Okay. It could have been earlier also. And I'm just telling, but okay, ठीक है. So you want to ask those questions now, or? Okay, sure. Okay. So yeah, ICDS, there were specific questions asked, and what our institute did was, instead of amending the guidance note, they came out with a technical guide on ICDS from our institute. So today, if you have to do a tax audit, you will have to look into the guidance note on tax audit report plus the ICDS technical guide issued from the institute. In 2018, there was a lot of change in the, I think these are the changes. There were a lot of questions. The 6 amendments plus 9 insertions. Total 15 changes happened in the tax audit report. They talked about minor changes, minor amendments. GSTN, because GST came instead of VAT or what sales tax. So GSTN number instead of VAT number. Then amount admissible under 32AD, deemed capital gains under 32AD, 43BG, railway assets, cash 269 ST, and then details of transaction not disclosed in TDS, TCS returns. 6 minor amendments and 9 insertions. They brought about 9 insertions. Advance received on capital assets forfeited under section 5629. What is this 5629? Earlier, if I had a advance received towards an immovable property, when I used to read income tax, they said whenever you sell the property, you appropriate that towards the sale value reduction and then consider it. Now what they have done is under 5629, if there is a forfeiture of an advance which is received towards immovable property, in the year in which the forfeiture happens, you will have to account it as income. So to that extent, clause 29A was inserted. 29B, money property received without or for inadequate consideration, 56.210. 56.210 is the most dangerous. Anything more than 50,000 rupees received in the form of money or property more than 50,000 rupees will be taxed. And they have defined property. And they said exceptions. The exceptions are if you receive from relatives, a trust, so many things they have told. If it is not covered as a transfer under section 47, certain clauses only. Not very important thing we have to understand is section 4. I always say 2 subsection 47 defines transfer. Section 47 says what is not transfer. Playing with the numbers, always it's easier to play with the numbers. 188, you remove 18, it becomes accounting standard 18. Easier to remember. 188 deals with related party transaction. 118 deals with accounting standard 18 deals with related party. 143.3 and 143.3. 143.3 of the Income Tax Act is the assessment order given by the assessing officer. 143.3 under the Companies Act is the audit report which the auditor is giving. Now 143 is the audit report, 134 is the director's report. I mean, you can play with numbers in a manner that it can be easier to understand. So I was talking about 56.210. Now before I came to 50, I said 47. Section 2 subsection 47 defines what is transfer. Section 47 negates what is defined as transfer. I mean, it says for the following transactions, although it is transfer, it is not considered to be transfer. Section 47. They say so many things. One of the things under 47.13b goes on to say that if a company is converted to an LLP, subject to certain conditions, 60 lakhs, 5 crores, all shareholders being all partners, etc., not 3 years, not the reserves and surplus not being withdrawn, etc., the transaction will not be considered as transfer. In section 56.210, he goes on to say what are all those things which is for the recipient, because transfer is from the point of view of the transferor. You must understand, if I am giving to Mr. Pramod, I have to look into my point of view for the purpose of 47 capital gains. From the point of view of Pramod, he is receiving something, so he has to see from 56.210 point of view. If it says that this is not considered as an except, it is considered as exception for 56.210, then Pramod will not be subject to tax. But there are certain things told in 47 which is not told in 56.210. What I was trying to say is, from the transferor's perspective, it could be exempt. From the receiver's perspective, it may not be exempt. So be careful. One of them is conversion of company to LLP. So that could be a danger. Of course, we have to work out on an argument. So 56.210. Then primary adjustment. Then this thin capitalization, GAR reporting. What now? I will talk about GAR reporting. Then dividend received under 222E. Then this specified financial transactions reporting under 61A, Form 61. Then this 286 and 44, Clause 44. These are the things which was brought in only in 2018. In 2020, the tax audit report was further changed to accommodate 115 BAA and BAB. BAA and BAB. What is BAA and BAB? All of us know. The reduced rate of taxation from whatever to 22%, which eventually becomes 25.17%, or 15% if it is a new manufacturing company set up, incorporated after September 2019, starting before 23, now extended in the budget, subject to certain conditions. So if you come under that, they said you cannot claim additional depreciation, you cannot claim so many things. If you had additional depreciation brought forward, they said you have to add it back to the block. From the brought forward, you have to remove. So all those changes were brought in 2020. In 2021, also it was amended, tax audit report was amended to bring in requirement of 115 BAC and BAD. That is for individuals, the optional rate of taxation. For the cooperative society, the optional rate of taxation. Why did I tell all this? The tax audit report, our guidance note was static. The tax audit report was dynamic. So now, to bring about dynamism in the tax audit of the tax audit report, the guidance note is going to be year specific. So for this year, it is assessment year 22-23, and the technical guide of ICI issued with respect to ICDS continues. What happened with all these thin capitalization, 269, 56 to 10, 56 to 10, 269 ST? Our institute came out with a hodgepodge. They did not change the guidance note. They brought something called an implementation guide on all these 6+9 amendments major which happened in 2018. All these things have now been merged in this particular book. The guidance note now merges that. So you don't have to look into that particular implementation guide. Definitely, you still, in spite of this guidance note, you still have to look into the ICDS. ICDS continues. So it's a single compilation except ICDS technical guide. Now, this guidance note has got beautiful, you must read it. Every year you have to buy this guidance note like a ready reckoner. All of us buy Income Tax Act and a ready reckoner. Okay. Along with that, you buy this. It gives you a lot of case laws. It gives you certain interesting case laws. That's what I'm coming to. So now it is updated for changes in the Act, circulars, and other provisions with respect to tax audit report. Please be forewarned that if the question is not there in the tax audit report, that matter will not be dealt in the guidance note. You cannot have it as a ready reckoner for all tax purposes. Yeah. Then reference to ICDS. You must understand that ICDS came after 2014. Therefore, reference to ICDS is there now. Ind AS came somewhere in 2000, I don't know, 17, 16. So it came in, the reference was not there in the earlier guidance note, now it is there. Accounting Standard Rules 2021. Here I want to pause and say that accounting standard until last year, we were for companies. Now all of us know that accounting standards for corporates, accounting standard for non-corporates. Non-corporates, I follow the institute's accounting standard. For corporates, I have two accounting standards, Ind AS and company's accounting standard rules. The accounting standard given, so what we call popularly is IGAP. So a company's accounting standard rules, 2006 is what we used to refer until 21 balance sheet. Until balance sheet 21, we used to say, I have complied with the company's accounting standard rules 2006, read with rule 7 of company's accounting standard rules 2014. Why was I referring to 2006? Please understand what is this rule 7 of 2014 rules means. They said the Companies Act 1956 rules of 2006 accounting standard rules was related to 1956 Act. 2013 Act they did not have an accounting standard. The 2013 Companies Act said, till such time I come out with my own rules, you follow the rules of my grandfather. I mean my father or grandfather, whichever. So they said, you follow the rules as given out in 1956 Act. And who said that? Rule 7 said that. Rule 7 said that. So therefore, every time we said, I have followed the company's accounting standard rules 2006, read with rule 7 of 2014 rules. Now this rule 7 is removed. The company's accounting standard rules 2006 is withdrawn, and they have brought out company's accounting standard rules 2021, which is nothing but a copy and paste of 2006. This they could have done long back. इतना सभी में बात करने का जरूरत नहीं था. Really. So the point I'm trying to say is I mean, the point is, if you are still referring to in your audit report Companies Accounting Standard Rules 2006, on the face of your balance sheet itself, I will know that you have not updated yourself. Beyond the face, I will not know. There may be so many things on which we may not have been updated. But on the face of it, we should be at least, there are two things. One, you should be appearing to be, and then you should be actually, at least in appearance, you should be good like Pramod. No, I'm sure intrinsically also he is strong. Okay, so Company Accounting Standard Rules 2021, new case laws. They have discussed, our guidance note talks about various case laws which will be useful, which we have quoted in the tribunals also. This is the case law, unless it is of course overruled at a higher court. But the point I'm trying to say is you get a lot of ideas. One of the ideas that we were always talking about is, and a guidance note has dealt with very beautifully, is on the bad debt. On the bad debt. Now what has happened is, if I have purchased something from Pramod, and I have to pay him, let us say 10 lakh rupees. What Pramod has done is, he has recorded the sales, I have recorded the purchases. In my book, I have recorded the purchases. Now the question is, after some time, my purchases to payable to Pramod is the entry that I have passed. And after 3 or 4 years, I have not paid Mr. Pramod. This 4 lakhs, I have shown it as I have just shown it as payable. I have shown it as payable to Pramod. Now what Pramod has done is, in his books, this 10 lakh rupees, since it has not been received for more than 4 years, he has written it off as bad debt. And today in the income tax return, bad debt, you'll have to give the PAN number also. So the department will come to know that I have not paid him. Now in such a situation, Pramod has claimed it as an expenditure under 36(1)(7). Can he do that? He can definitely do that. The moment he writes it off in his books, he can claim it as an expenditure. Now the question is, Mohan avarige namaskara, bani sir. The question is, should I, the moment he claims it as a bad debt, show it as a remission of a liability in my books? That is the question. Or there are two issues. One is more than 3 years. There is something called law of limitation. The law of limitation says, for every 3 years, you should take an acknowledgement of debt. Otherwise, the debt lapses. That is how in the banks we talk about AODs. Okay. Now, in this context, I have not paid him for more than 3 years, nor I have remitted it. I mean, I have done, but Pramod says that 10 lakh rupees, he has written it off as a bad debt. Now, the income tax is writing to me that he has claimed it as a bad debt. You better show it as your income. So what should be my argument now? My arguments are two. One thing is, I am very good. I want to pay him. Although it is more than 3 years. Where is the acknowledgement of debt? The fact that I have recorded in the books and shown it as payable itself is an acknowledgement of debt. The acknowledgement of debt is from the receiver's, for the person who has to receive, not from the point of view of the payer. So I have shown it as payable, so therefore it is a debt. Just because he has claimed it as a bad debt, you cannot force me to show it as a 41(1), remission of a liability. So that they have a wonderful case which has been given. All these things have been told in the guidance note. Giving the case law, they have told that you cannot trust. However, after telling all this, this was a live case, we told the income tax department in the faceless assessment, then please get a letter from Pramod that I don't have to pay him. Then I will offer it for tax. Pramod, kodri letter. No, but the point is, he might have written it off for whatever reasons that he wants to, because bad debt is, you can create bad debts, and once it is received, you of course have to offer it for tax again. But having said that, his action, it's a unilateral action, not a bilateral action in that particular sense. So all these case laws have been told in the guidance note, such things, and which we can actually quote it. Now, one thing which has happened last year, until last year, in my firm, I am drawing more than 50 lakh rupees as interest and remuneration. I am a professional. My firm is of course a professional. Should I subject myself to tax audit? Yes or no? What is what is the cutoff for a professional? And I'm a specified professional. Forget about this. See, 44 ABA, 1 crore is for business. For specified professionals, only for 44 ADA. When it comes to class B of 44 AB, all professionals come under 44 AB. 44 AB class B may all professionals, the cutoff is 50 lakh rupees. So I have received more than 50 lakh rupees from my firm. Not as, forget about, see, sir, if I have received only a share of profit of more than 50 lakhs, our institute very clearly says don't include exempt income for the calculation of your turnovers. But this say the interest and my remuneration, if I have drawn more than 50 lakhs from my firm, according to 44 AB clause B, I have to subject myself to tax audit. Yes or no? I mean, you agree with me? Tribunals have held. There is a very famous PricewaterhouseCoopers partner case, which said that he will be subject to penalty under 271B for not getting the tax audit done. 0.5% restricted to 1.5 lakhs. So having said that, until last year, I was doing my audit also. My firm audit and my individual audit. This year I have stopped. Because there is a Mumbai High Court decision, Perizad Irani case, Mumbai High Court, which has now been dealt with by the Institute Guidance Note also. So I have double force now. I can take the Mumbai High Court and tell my Institute Guidance Note also. Because if something is told in the Institute Guidance Note, he cannot levy a penalty according to. I will tell, because Institute is part of a regulator, it is not part of some association. If a regulator is telling, so I would, sir, your views.
Yeah, no, naturally, because the authority attached to the guidance note is, it is recommendatory in nature. Members are expected to adopt the guidance note unless they have a valid justification for deviating from the guidance note. So that is a shield what members can have. That is.
So the point is, now I have stopped. And any one of you here or people pratyaksha paroksha ಇನ್ನು ಫ್ಯೂಚರ್ ಅಲ್ಲಿ ಯಾರಾದ್ರೂ ಕೇಳಿದ್ರೆ ಅವ್ರನ್ನು ಪ್ಲೀಸ್ ಸ್ಟಾಪ್ ಮಾಡಿ. Don't subject yourself to audit. See that while it is good from the point of view of the chartered accountants not subject to audit, but for the chartered accountants who were doing the audit, it is not so good. That's a different point. The point, okay, so such cases are, so reference to level 1, 2, 3, 4 to non-company entities and applicability of accounting standard with effect from 1/4/20 is discussed. Tax auditors may consider inviting attention of assessees towards technical guide on financial statements of non-corporate entities. Now, this is a hot topic. There is now the institute has come out with the technical guide on giving the format of financial statements for non-corporate entities. Now, can I take a tally format, or should I have a Schedule 3 format for non-corporates also? If you see non-corporate entities format, it is the same as copy and paste of Schedule 3. So in short, follow Schedule 3 for non-corporates also. Please understand, it is a prescription. It is not a tax. There is a difference between a prescription and a tax. Tax means it is with an authority, you have to. The same what sir talked about guidance note and a standard. An accounting standard is a tax on the chartered accountants. You have to follow it. You don't have an option of not following it. When it comes to this particular point, they have told it is prescription. A doctor prescribes medicines. ತಗೊಳ್ಬಹುದು ತಗೊಳ್ಳದೇ ಇರಬಹುದು. ತಗೊಂಡ್ರೆ ನಿಮಗೆ ಒಳ್ಳೇದು, ತಗೊಳ್ಳಿಲ್ಲದ್ರೆ ಪರವಾಗಿಲ್ಲ. Sir,
this is one step ahead. It is not even a guidance note. It is a technical guide. A technical guide is one step below the guidance note. But the only thing is, okay, once you are comfortable, you can adopt and whatever the format is given, but you need not get alarmed. That is, yes, it should be done only in this format. That is the thing.
Perfect. Perfect. So while it is good if you follow, it is good. I think over a period of time, they will make it sort of compulsory like an accounting standard, but it looks like the thinking has started. Let us see how it happens. For the moment, it is recommendatory, not prescriptory in that nature. But they have told in the guidance note, sir, they can only say better follow. That's all. They will not be able to tell you anything, nothing more. Okay. Tax auditors, that's why I underline the word may consider. may consider. Then warnings about normal mistakes. This particular guidance note has gone into the talking of Taxation Audit Quality Review Board. I think Pramod and Chairman, I will close in 5 minutes. Hello, that's how. Okay. So Taxation Audit Quality Review Board is equivalent to Financial Reporting Review Board, which reviews the financial statements. Taxation Audit Quality Review Board looks into the various certificates and reports given for the purpose of income tax, GST, etc., and finds out if there are any mistakes which could eventually lead to disciplinary proceedings. One of the normal mistakes that they have found out is, in the case of an audit of a company, there is a question under which clause are you auditing? In the case of a company, 44AB, clause A, clause B, clause C, clause D, clause E. And then there is a proviso to clause 44AB. Which is the one you are ticking? Normally, in our office also, before I saw this some 3-4 years back when it came in the journal, we were casually ticking 44AB clause A. Now, once I read that, then there is a proviso which says, if there is an audit conducted under any other audit, and any other purpose, which means you are following 3 CA, the audit that you are doing is not under 44AB clause A, B, C, D or E, but under the said proviso. So you'll have to tick that said proviso and not A. So this is now, such things have been brought out as normal mistakes which are found out. Gist of some of the FAQs issued by ICA is covered. Some of the interesting FAQs that have been covered. So how many tax audit can a tax auditor do? ಎಷ್ಟು ಮಾಡ್ಬೋದು ಮೇಡಮ್? ನಾನೇನು ಏನು ಬರ್ದಿನಲ್ಲಿ ನನಗೆ ಸರಿ ಕಾಣಿಸ್ತಾ ಇಲ್ಲ. ಎಷ್ಟು ಬರ್ದಿ ನಾನು? How much I have written? You also can't see him. Okay, very good. 600 tax audits can be done by one chartered accountant. Our guidance note has told. Yes. What I was trying to say is 60 tax audit per auditor. We always used to have a question that if I and Mr. Manor Gupta sir are partners, I wish I was. Okay. Now I want all the 120 audit reports to be signed by Manor Gupta sir, and I will be doing some other thing. Can it happen? Can it happen? A lot of people were saying, how can one person do 120 audits, quality issues will be there, etc., etc. Then I said, I am doing all the company audits. He is doing all the tax audits. Is it not good? I am specializing in company law. He is specializing in, because for me 143.3 means something and for him 143.3 means something else. So I'm just trying to say that. The answer was given. I was always saying yes. There was an FAQ also which said yes. Now within the tax audit guidance note itself, they have told that if in a firm of 10 partners, one partner signs all the 600 audit reports, it is good. But I would say that example should not have been given. 600 audit report, they should have given in Sunday the example in Koto. If he signs 100, the other person signs 20, or one person says, unbelievable. ಒಂದೇ ಸರ್ತಿ 600 ಅಂತ ಹೇಳಿದ್ರೆ ದಿನಕ್ಕೆ ಎಷ್ಟು ಮಾಡಬೇಕು? I was just saying it is not 600 divided by 365.
He's only signing part.
Then the institute, I would say, they should not have gone to this extent of making it look simple. Yeah. So 600 tax. Then the other important point to be noted is, please understand that one branch audit is also considered to be one audit. If you are going and doing a branch audit of a bank and sign a 3CD, that is also considered as one. What is not considered is 44 AD and ADA cases breach below the 8% or 50%. If you are signing, that is not considered as a number in that context. Then update UDIN in 15 calendar days in the IT portal. Although for UDIN for the institute it is 60 days, for IT portal purpose it is still continuing as 15 days. Else the tax audit report and the certificate will be invalid. No place to mention UDIN or para SA 700 in portal. So write in the hard copy and give it to the assessee. Earlier signed hard copy of financial statement. Now, okay. Updated version of guidance note offering for each year we have talked about. Now I have to close by giving something on 33 and 44. If for any particular aspect reporting is required at more than one clause, something for ICDS and something under depreciation. If I give it under both the clauses, it gets added under 143(1)(a). Our institute has now told, give it in one place and give a reference of that in the other place. If there is no mouthpiece for that, you put it into your observation. Okay. Now both under exclusive and inclusive method we have seen. Now disclaimer 33 talked about GAR. ಏನ್ ಮಾಡೋಣ ಶ್ರೀನಿವಾಸ್, ಇಲ್ಲಿಗೆ ಬಿಟ್ಬಿಡೋಣ, ನಿಲ್ಸ್ಬಿಡೋಣ. 33 and 40 ಈಗ I had something to say. 12 ಆಯ್ತು. ಇನ್ನೊಂದು ಅಷ್ಟೇ ಅಲ್ಲ. ಸೊ 12:15 ವರೆಗೆ ಹೋಗೋಣ, ಇನ್ಕ್ಲೂಡಿಂಗ್ ಕ್ವಶನ್ ಅಂಡ್ ಆನ್ಸರ್ಸ್. ಓಕೆ ಓಕೆ. Class 33 is on GAR. Now class 33 I will talk very less. Class 44 I will talk a little more. How to approach from the audit angle. If at all you decide to fill in the session 3, Annapurna, isn't it? Annapurna Kabra. She will talk about class that if at all you decide to give, how to give, what is exempt, what is composition, how to fill in, that is what is going to be talked about. Our guidance note talks about, now first of all, whether 30C and 44 is applicable for financial year 21-22. That is a big debate, because the notification said up to 31/3/22 this is kept in abeyance. So we had a big discussion, our group. A divergent view came, and one of the view I said not applicable. I can say that it is not applicable because up to this is for 31/3/22. But if you look into the original notification, it said the signatures made up to that date, it's not applicable. So now we are all come to a conclusion that it is applicable for 22-23 assessment year. Okay, that is no doubt about it. Having said that, how are you going to fill it? The required information is not there. For class 44 I am talking about, the required information is not there. What the guidance note has told is, while you may decide to give that, if the assessee himself has not prepared, it is not your mistake as a tax auditor. It is not your mistake. So therefore, they have told a couple of things. If you want to give, headwise, nature-wise, not required. So what is this breakup? Let us see. Although maybe, yeah, you have to give the, yeah, this is the breakup that you have to give. Total amount of expenditure incurred during the year. Then you have two columns: expenditure in respect of entities registered under GST and expenditure relating to entities not registered under GST at the extreme. So I would put not registered under U. And if you are buying it from a registered entity, you have R1, R2, R3. R1, R2, R3 is, R1 is for the registered entities from whom you are buying exempted goods. R2 is registered entities under composition from whom you are buying. And R3 is the majority. R3 is relating to other registered entities. All R1, R2, R3 will together come as total payments to registered entities R. So which means in your P&L account, will it go to balance sheet also as an expenditure? The answer is yes. According to the guidance note, expenditure does not restrict to P&L account expenditure. It goes to balance sheet items also. So all those expenditure which you have incurred, it is receipts and payment, all payments for which you have done claimed it as an expenditure, you will have to give, not for income tax purpose, but for GST purpose. You will have to give that information in this particular. So should it be, now once I say total amount of expenditure incurred, will I give traveling? Will I give printing and stationery? Should it be given by nature of expenditure and head of expenditure? The guidance that is given from our institute is not required. Total, if you give, it is sufficient. If you give total, it is sufficient. Headwise but nature-wise not required. Total is sufficient. So you give one number. But for all these numbers, you should have a proper documentation. CapEx also to be covered. Separate. If you keep it separate and have a proper reconciliation, elaborate reconciliation may be required. If the assessee does not have it, disclaim. If the assessee provides reasons for not being able to provide the details. How will you give the disclaimer? Yeah, I think that as well also class 33, I will show you the disclaimer which is given in the guidance note. For class 33, they have given a very good disclaimer, but for class 44, we have derived. In our office, initially we took like this. The assessee has not provided the breakup of the total expenditure as required under class 44 of Form 3CD, and therefore we are unable to comment on the same. This is one way. If you want to expand it further, and normally to the best of my knowledge, as per the information explanation provided. So if you want to say like that, not as informed by the assessee, ask him to inform you. which means you have to inform him and he has to inform you. That is what is management representation letter all about. Please involve him. Don't suo moto go and say he has not provided, because tomorrow if there is any penalty for not giving this particular thing, or if the department finds it something, he may have a special audit, then the assessee should not point fingers at you. So you please discuss with the assessee. So therefore, as informed by the assessee, the information required under clause 44 of Form 3CD has not been maintained in the absence of any disclosure requirement thereof under the GST statute. Further, the standard accounting software used by the assessee is not configured to generate reports as required under this clause in the absence of any prevailing statutory requirement. Therefore, it is not possible to determine the breakup of total expenditure of entities registered or not registered under the GST. In view of the above, we are unable to verify and report the desired information in this particular clause. Then there are other situations given. I will share it with you. The point I'm trying to say is, for this year, I don't know, very, very, very difficult. We thought that it will not be applicable or scrapped. In fact, the Chamber of Commerce, Shravan I.S. Prasad, has sent a memorandum to the Finance Minister to remove this from the Income Tax Act. It is like PF is more benevolent than the income tax on PF. Now, income tax is asking what is not required by the GST itself. So that is the point that they have brought in. On clause 33, what they have told. What is clause 33? GAR. Impermissible avoidance arrangement, IAA. If there is any impermissible avoidance arrangement, that means a proper, it could be tax planning, which could be called as tax avoidance from the income tax point of view. If there is any transaction which could be leading with the pure objective of tax reduction, which I could call it as tax planning, the assessee could call it as tax planning, but the department could call it as tax avoidance, then it should be, impregnated. So impermissible, it is not permissible. So they will remove the corporate will and tax it. That is what is GAR. And it could be between so many entities involved, not necessarily one case. It could be more than one person involved. So what they have done is, if the total savings, that's what Monar Gupta sir said, if the savings between the person and the other group entities is more than 3 crore rupees taxes, more than 3 crore rupees taxes, then GAR kicks in. And the assessing officer, if he finds out the smell of this particular tax avoidance agreement entered into, he can refer it to the panel of commissioners, who will then issue a show cause notice and ask question, etc., and find out whether there is a tax avoidance in that particular scheme. This is what happens with the department. Now in clause 30C, they said, 33C, they said the tax auditor, without having a benefit of panel, show cause, etc., and in some cases he may be a tax auditor of only one entity. He doesn't know, and he thinks that it is only 30 lakhs here, but there it could be 4 crores. So put together, it would be more than 3 crores. So how should he deal with such a situation? Our guidance note has spent a lot of pages on this particular aspect. What they said is, immediately if you feel that there is an impermissible avoidance agreement, if you want to comment, you can comment. That's the first thing that they said. The second thing is, if there is already an impermissible avoidance agreement pointed out by the department, then you may have to concur with them. Unless you don't want to, you have a forceful reason, or if it is held so, then also you may have to comment. In more often than not, they have said that there may be situations where the tax auditor will not be able to take a decision for various reasons, because in his opinion it is fine, or maybe he's not a group auditor where he can get a complete picture. So how do you deal with that situation? The institute has given a very beautiful disclaimer on that. So this is the disclaimer. And what they have said is, if you do not want to follow elaborate investigation process, not consonant within the confines of the audit, and due to lack of access to books of accounts and other records of the other parties to the arrangement, if the tax auditor is unable to come to a conclusion which he can certify any arrangement to be true and correct, he should make appropriate disclaimer in respect of reporting under the clause. So what is the disclaimer? And the wordings are so beautiful. In the absence of access to the books of accounts and other records of various parties to the arrangement, and want of elaborate investigations beyond ordinary process of audit involved, in determining whether the arrangement is an impermissible avoidance arrangement, and in determining the tax benefit in the assessment year relevant to the previous year under audit arising, in aggregate to all the parties to the arrangement, we are unable to determine the view of the assessee regarding its entrance into any impermissible avoidance agreement as contemplated under 96 of the Act during the previous year. Beautiful wordings. Just like in Caro also, they have given beautiful wordings for the Kavade, I mean for the astrology case, what we discussed. So where they said, does the assessee have the wherewithal to meet its liability in the next 1 year? And IB always used to say, how do you tell this? Whether he has the wherewithal means, you see if he is paying the audit fees promptly, then he has got the wherewithal to. Recently, I discussed this with, I want this to be off, I'll tell you. See, the point is, they said, the auditors, sir, this is how, there's a question like this and we have to answer this way. What is the way? Depending on how fast you pay the audit fees, we'll decide on this answer. He said the auditors are telling so many lies. This lie also you tell that you have received the audit fee. They're also smart, I'm saying. Okay. Now, according to the information explanation given to us and on the basis of financial ratios, aging, etc., nothing has come to our attention which causes us to believe that any material uncertainty exists as on the date of the audit report. And because we, however, state that this is not an assurance, after saying that we are going to, it's not an assurance to the future viability. We neither give any guarantee nor any assurance. So this is how the, I mean, the wordings, you cannot change any wording. So beautifully it is done for the purpose of Caro reporting. Even here for class 33, for class 30C reporting also, the wordings cannot be changed. It is very beautifully worded. So with that, we have to somehow come to an end. I can take up questions.
Before the questions are taken up, I just generally I have received some inquiry queries from other professional colleagues. One point they are raising is the rounding off of the numbers. You see, in case of non-corporate assessees, there is no mandatory requirement of rounding of numbers in the financial statements. That is required only under the Companies Act. Whether you are following under Ind AS or IGAP, now it is mandatory that the number should be rounded up to the nearest, whatever lakhs or thousands or whatever that may be. But that may not be there for tax audit purpose. See, particularly for the financials, what we have to file with the income tax department, it should be in absolute numbers, not in rounded off nearest lakhs. That is the one point. But in case of non-corporate assets, there is no rounding off requirement. Because some people, they get confused whether rounding off how we should do for partnership firms and all like that. That is not required. Another important point is business perks, disclosure of business perks in the tax audit report. Because there is no way the whatever business perks are received in kind, it will not appear in the books of accounts. So generally what we should rely on the management representation we should take. But there are instances now, furthermore, now by introduction of 194R for TDS, before extending the benefits. So this is more relevant that we have to take care that business perks are not omitted in the tax audit report where such cases are there.
Always say they have introduced R in the year in which RRR came. So next year there will be 194 KGF. Okay.
Questions? Just before that, just one pointer for the benefit of all the members, sir. In our tax audit reports, we refer to our audit of the financial statements. So it might not be possible that we give the full number in the tax audit report as well. In that you have a view, because we would have referred to our audited.
No. The point is, for the purpose of audit of financial statements, you have given the full number.
Yes.
For 3CD, there is no rounding off.
Exactly.
For 3CD, because the observation with respect to the 3CD is given separately, and therefore in 3CD you have to give the full numbers.
Yes. Yeah.
So income tax return also full numbers.
Yes.
Forget about income tax return. See, Schedule 3 and income tax are from two different statutes. Okay. This, whatever this round off says, this need not say. Within Companies Act, there is a round off in the financial statements, but under AOC 4, you have to give full figures. When I am a member of a CLCGS and I was talking in the committee that we should give a representation for AOC 4 round off means one of the central council member was saying no, they are denying. They want AOC 4 full only. I said, when they want Schedule 3 round off, why not for AOC 4? But they want for certain compliances full numbers. So that will be given in AOC 4. So within the same act, there is a round off and a square off. I mean, not so round off. Yeah.
Quickly, from Raj Gopal T, whether the management confirmation letter about non-payment or receipt of cash for more than 5% will serve the purpose of fixing the tax audit limit to rupees 10 crore.
See, there I would tell you one thing. Why do you need a management representation letter on a subject, on an assessee for whom you are not doing the audit?
I think his
See,
question is
no, point is, if you are not doing an audit, you are not the auditor.
yes.
Why do you need a management representation letter? For doing an audit, you need a representation. First point. Second point, management representation letter is very, very important. Only on debatable issues. On an apparent issue, you cannot take a management representation letter. Even our guidance note now says, and 580 also says, that management representation letter should be a second, third, fourth line of defense. It cannot be an offset for doing the regular audit. You have to do your regular audit, and in worst situations where you don't have 1, 2, 3 line of defense and MRL itself is the defense, you must say that in your audit, in your observation, that I have relied only on the management representation letter for this purpose. To that extent, guidance is given. Do your diligence promptly. I mean, you can trust the management representation letter, but verify. Trust but verify should be the way forward.
Second question from him is, please include otherwise than by cross-check NEFT, RTGS, etc. in my query. I think it's not a full question.
Yeah.
And from Poonam Jain, Caro is not applicable to small companies and few private companies whose borrowings are less than 1 crore and some other criteria. If a private limited company is following in the definition of small company but having borrowings more than 10 crores, is Caro applicable or not?
Not applicable, not applicable. See, what happens is, I always say this, first thing is whether it is a private limited company or a public limited company. If it is a public limited company, Caro is applicable. If you are a private limited company, first you see whether I'm a small company or other than a small company. If you are a small company, Caro is not applicable. You don't even have to test the other criteria. If you are other than small company, then you say whether I'm breaching that and I'm not breaching that. So if I'm breaching that, only Caro will be applicable. So in short, if I am a small company and having a borrowing of more than 1 crore, I don't have to do Caro.
Because of subclass 4 and 5. Because subclass 4 is not applicable to small companies, they said, then subclass 5 is redundant, but still they retained it.
No, but our guidance note on Caro has told this very clearly also. And it is so, because once you are a small company, you are a small company for all purposes, as long as you are within 220. 220 is important. 220. What is 220? Paid up capital 2 crores, turnover 20 crores.
In respect to clause 44, whether payments like electricity charges, duties and taxes like GST paid under composition dealer cases and income tax debited to P&L and remuneration paid to partners, whether needs to be disclosed or not.
See, these are all not subject to TDS. Subject to GST. Although session 3 can delve into that in detail, I would say they are not subject to. It need not, all the figures in your P&L account need not tally to your that particular clause 44. Is my opinion. But for every number, you have to have a backup now. This itself could be a separate audit. This itself should be a separate audit, and I don't know who is the beneficiary of this particular. Therefore, disclaimer is a practical answer to this particular question. Yeah, I think we'll take his question, Pramod.
Mike?
I think you should use the mic, otherwise people in Belgaum cannot hear. Maybe other places of Bangalore they can hear. Your name also, please.
Hi, this is Bharat here.
Mirath.
Bharat,
yeah.
so this clause 44, does this confer with the objective of this tax audit report?
I don't know. They don't put any objective for each clause of the tax audit report. Having said that, what they want to probably find out eventually is, if you have bought something from the unregistered dealer, that could be subject to greater scrutiny. Maybe that, if that is so, then why R1, R2, R3? Only you should have been asked, isn't it?
going like builders and everybody have to take from registered dealers 80%, that rule is there. Are we also moving the other dealers?
That should be it should be problem of GST, no? Why should income tax get into the territory of GST? No, let us move towards that, but then why some other authority should be worried? It's like a brother and sister again. Same thing I was telling. Na? The brother is more worried than the sister was the sister's own case. Yes, Pramod.
Then again on clause 44, assessee has not availed the credit though he has purchased from registered dealers. Should we still classify as per clause 44?
Session 3. Question to session 3.
Yeah.
Because I tend more towards giving a disclaimer. Sir, your views.
I would also prefer that we should give a disclaimer. That's what we have taken a call in our office also. Let us give a disclaimer.
Start saying not applicable for this year. Not applicable for this year, but it is applicable. And then we said, okay, it is applicable. We said with the simple disclaimer saying that if you get into the details, यार इनकम टैक्स में जीएसटी, इनकम टैक्स में पीएफ, इनकम टैक्स छोड़ के सभी आ रहा है. That's the problem.
See, they said GST audit is not required by chartered accountants. Indirectly, they are bringing up through clause 44 beyond GST audit in the tax audit report.
Yeah, for the assessee, it is buy one get two free. That's the problem. Yeah, that's it. Okay, thank you so much. I think no, if there are any questions, I'm available for tea. But I can only ask you one question, which was there in my slide. Answer this one question and you will get the objective of tax audit. Who is the tax auditor working for? Now, please answer this very, very importantly. And understand also that auditor is not the final authority. There could be peer reviews, there could be disciplinary matters, there could be anything. And you can come out free, that's a different issue. But auditor is not the final authority. This is what you'll have to impress to the assessee also. And also tell him that the client is not your boss. No, client is not your boss. He has to be, I mean, you are doing an audit which is to be definitely independent, arm's length, etc. So you may attend his daughter's wedding and he may attend your daughter's wedding. But at the same time, ask this question that I am recognized not by the audit, not by the assessee or the client, but by section 288 of the Income Tax Act. That gives me the power to sign the the tax audit report. Otherwise, it would be sooner than later. I was talking in the beginning, a parabola. Okay? Thank you so much for this wonderful knowledge enriching session. Thanks, Pramod. Thanks, Srinivas.
Thank you. Thank you, sir. We had an excellent session. Of course, the fact of, I thank you personally also for reminding the 2021 aspect of it, because in the guidance note itself, it still says 2006, which was released in January. So of course, do make a note of this when you are issuing your financial statements and the audit report. Thank you for the enlightening session, sir. Of course, Manohar Gupta, sir, wherever required, he did throw the light on his experience and the way it should be dealt with. Thank you, sir. And we'll have a quick tea break for 10 minutes. Sorry. And before that, I request Chairman of Bangalore branch to, as a token of gratitude and respect, just us. Yeah. Thank you, Chairman.